Welcome to FinTalks, a chat with Finance Malta. With me today I have Fiorentina D'Amore, Head of Compliance and MLRO at eToro and Chairperson of FIMA, which is a financial institution, Malta. And during this podcast we will be discussing the financial institutions as the pivot of an economy's system. Thank you, Mrs. D'Amore, for joining us for this chat.
Thank you for inviting me.
My first question is lean and contactless operations. What are the opportunities and the threats?
So first and foremost, one needs to understand what financial institutions mean in our economy today, in the ecosystem. By financial institutions, we mean financial institutions that are non-banks. So that they are not fully fledged banks offering all the products of banks. Fintech in general is a market and consumer-driven phenomenon. And this means that it's built around the needs of the consumers, the needs of the business consumers and the retail consumers, and it's built through and by and with disruptive innovation and technology, hence the fintech buzzword. Some describe it as the evolution of traditional banking, but I disagree with this statement. Financial institutions are the result of a disgregation of banking services into micro specialized units that function within the same let's say, economy. Think as the bank as the shopping mall, and as financial institutions as the deli or the boutique or the specialized shop. Can we live without one of the two? I don't think so. In order to have a better array of products and offerings, in my opinion, a healthy economy, a healthy ecosystem for financial services is one that includes both. So I do not see them as competitors. I see them as different animals in
the same sector.
In the savannah. Yes, exactly, of economic areas. So it's a different experience. There are many positive considerations that we can do about financial institutions in this scenario. First and foremost, they differ in culture and structure. The way FIs are structured is a plus already in its own merit. They are smaller, they are flatter organizational hierarchies. To the average age bracket of CEOs is always lower compared to traditional bankers, and decision makers are always slightly less in number than in traditional banking. So you might find less committees, less red tape, less bureaucracy, less time, beg your pardon, less time between design, launch, decisions, and replies even to customers. So that is definitely a plus. It is also it is also important to consider the fact that financial institutions thrive on innovation. So the R&D departments in a financial institution is not a department tucked in somewhere within the structure of thousands of employees company, but it is the business itself. So the R&D, the research and development, the innovation, sometimes is the business itself. Many times we observe that the innovators are the founders of financial institutions, are the CEOs of financial institutions, not just a segregated department. And this creates vision, and it also creates, let's say, a better environment where things happen fast and where things are created. In smaller organizations, one generally finds a fluid approach to decision making, as I said. When you work in an FI, you are expected to speak to the CEO on a daily basis because he would be either working in the same office, sometimes in an open space, and therefore communication happens fast and seamless. In a knowledge economy, communication is the key. So And speed is also key, because when we are talking about innovation, we're talking about the importance of being the fastest and swiftest out there in the market.
So you don't agree with the argument that the banks are dying a natural death?
No, I do not agree personally with that statement, because I still believe there is a need for banking. If you think about mortgages, if you think about the principle of one-stop shop, they create a lot of value. Of course, they're a different kind of animal. They're larger and they're more difficult to manage sometimes, and the culture can become and does become quite heavy and political sometimes.
Yeah.
So we know that.
So with regards to leanness, so that everything will run smooth, what should one look for?
Right. So by default, a smaller organization is easier to manage and easier to control. When it comes to risk, financial institutions do not lend money that belongs to clients. So the value at risk is low. This is the reason why FIs do not require to carry out intensive exercises such as ICAP and ILAP, where the capital is apportioned according to the risk that the companies are taking, that the banks are taking, vis-a-vis the investments that they are carrying out with the funds of their own clients. So that is one benefit that FIs are leveraging on. Also, most FIs are specialized around one or two products and services. And this translates automatically into better control, better understanding, and also more focus and mitigation of risks related to those products. The other element of in favor of being a lean organization is costs, of course. A relatively smaller company tends to grow faster because it's lean. It's never face-to-face, so the entity can reach clients en masse through technology such as mobile apps, social media, and also internet banking, and penetrate markets which are far away from the area of operation without necessarily setting up business in those areas, physical business. And because every company specializes in something, it's also easy to become modular and partner up with other players in the industry. So let's say I do payments and you do cards. We partner up together and we offer our respective clients a vaster array of services, more service offerings, and of course without incurring the costs of delving into those businesses. So I do not need to make great investments in equipment, personnel, knowledge, software, etc., because I have a partner which I'm co-sourcing with. So that is something which is a huge positive in the industry, and it's happening. It's happening as we speak, and it will continue to happen, and it will continue to grow. All them clusters. So imagine having a car that is cheaper to run and faster to drive. So that is the financial institution concept. It's something leaner and something more efficient and effective, both from an investment perspective as well as from a revenue investment ratio.
Yeah. What about risks and clients' funds protection? Are funds deposited safe with financial institutions?
So this is probably the most misunderstood and misrepresented fact about financial institutions. It is basically related to the fact that traditional European banks are obliged by regulators to offer something which is known as the Depository Compensation Scheme, which protects up to €100,000 or equivalent of client funds per client. Not per account, per client. The reason why FIs do not offer the Depository Compensation Scheme It's very simple. It's because, unlike banks, they do not lend, they are not even allowed to lend or reinvest funds that belong to their clients. Therefore, the funds, by law, are kept in segregated accounts within financial institutions, which are banks, regulated in reputable jurisdiction, usually it's Europe, in segregated accounts nominated as client accounts. And they are left there for the benefit of the client. So should the client pull out his cash, the availability is there. So what happens if an FI defaults? What happens to the money of the clients? Are those money protected? Yes, and they are protected in its entirety. The balance is completely protected, not just 100,000, but it is protected as it would be guaranteed in a liquidation where the creditor has a right to his own funds.
So the same concept that we were used to traditionally with the bank, same applies to FIs.
I might say it's even better because you have 100% of your capital and not just 100K. Because if you have 1 million, you might be losing 900,000 through the depository compensation scheme if the bank defaults in the unlikely event that it happens. But we've seen banks default and the depository compensation scheme served as a lifesaver for many investors and for many bank account users. But we need to understand that the depository compensation scheme is there to protect because the bank is taking certain risks with clients' funds. And it is the way that banks work. Bank lend money that does not belong to them to other people, and it's in a cycle.
Yeah.
So they need to make sure that they have a liquidity which is commensurate with what risks they're taking.
What about the industry risk appetite? Why do FIs seem to be more risk tolerant, more lenient? Is this a fact, or again, this is a perception?
So I believe that there is truth in both assumptions. The higher the risk tolerance, might derive from the fact that FIs are focused on less products, and therefore they can concentrate on those risks, and they can invest all their time mitigating those risks. So there's less dilution in terms of effort. On the other hand, we know that large banks around the world, not only locally, are de-risking because it has been imposed on them by EU regulators, and massive players have closed down in the past 2 years within the European Union, and this has created a lot of gaps in the service provision. What does it mean? It means that there has been thousands of account holders which were orphaned of a bank and which required immediate services. Where did they find that support? In FIs. Because FIs were there to support this situation without elongating too much and delaying too much the service provision due to their leanness.
Yeah. So, but basically, if you take this in the first context that we were talking in the first question about leanness and contactless, so both of them have to survive because it's important for society to have basically a choice of where to go, right?
Yes. Just to go back to the example of
not to have a one-stop.
Exactly.
One shop, I mean.
Just one. We live in an era where we are spoiled for choice, and it should be that way because consumers, clients, businesses, needs are changing every day, and the financial institutions and banks need to understand this. They need to gauge on this, and they need to create products and services which are helping the businesses grow.
Yeah.
Sometimes innovation means that you are creating something that is needed before your consumer knows what he needs and you propose it as a solution. So financial institutions are not an added value. They are a solution in the market. And that is what makes them very, very successful.
With regards to financial institutions, again, are there any negative elements within the industry itself?
Of course, nothing in this world is perfect. And many opportunities I mentioned and many positives I mentioned have a dark side too. The challenges of the industry are complex as their dynamics are. Take, for example, speed to market and the importance that financial institutions give to be the first with propositions in the market. From an operational perspective, fast-paced projects driven by high competition could potentially suffer imperfections, and we observe that at times we go to market fast, but then have a product that needs readjusting and readjusting and readjusting. So you would be spending a year developing a product and another year optimizing it. But that is a trend, and I think that the majority of FIs have adapted to it to a point where they manage to be quite efficient at preventing massive mishaps. When it comes to remaining lean, we have to understand a very important factor here, and it's the concept of outsourcing or co-sourcing. Outsourcing business functions or partnering with other stakeholders in the industry requires a great deal of internal controls and quality checking and setting of KPIs and reviewing of policies, procedures of other participants, because automatically those risks become your risks. And because you are not fully in control of the operations of those functions, you need to establish a very, very stringent and robust safety net for that and monitoring for that. The speed at which transactions take place and the fact that clients are never met, or 99% of clients are never met in person, also puts a lot of strain on the risk of AML and CFT. We know that we implement technology to help us mitigate that. However, the risk of financing of terrorism and money laundering is always there. How can you mitigate these risks in simple terms? Companies need to beef up the departments of AML and CFT, risk and compliance, commensurately with the risks they're taking, with the number of clients they have, with the number of first-line employees they have, and they need to understand that if it's true that from a liquidity risk perspective, we are not obliged to report ICAP and LICAP, so the obligations are lighter, from an AML perspective, the obligations are identical to those of a bank that can, that have the luxury of having departments in compliance and AML of 40, 50 people. So we have the same obligation. So we need to find a way where we don't have 2 or 3 people in a department of compliance and risk, but it is beefed up with personnel, with trained personnel, as well as technology and investment needs to be there.
And for the sake of those people who are following this, especially people who are interested in investing in Malta, who would be checking that an FI has all the necessary technology, personnel, trained personnel, professional people before it opens its doors?
So there are at least 2 layers to this. The first layer is the checking of the qualifications of the people who are the money laundering reporting officer, compliance officers, the CEOs, the board of directors, the head of risk departments, and also auditors and other key staff are PQ'd. PQ'd means it's an acronym for personal questionnaire. It's an extensive and very, very granular, let's say, questionnaire that actually is aimed at understanding if a person is fit and proper for that role. So the combinations are generally experience as well as academic qualifications and personal attitude, because this is a job that doesn't occur behind closed doors. So the MLRO or the compliance officer wouldn't be a person that's along with a computer or along with the software. It's a person that needs to have sufficient seniority and command, as the law stipulates literally, and needs to have a certain personality that allows them to put their foot down when they have to put their foot down, or to provide solutions which are robust enough but also flexible enough not to block business.
Okay.
And that's probably the biggest challenge.
Okay. Shifting to FATF, increased monitoring, what are the implications for the industry, and how should the companies themselves, the financial services itself as a sector, should react and act?
So, it is a known fact that in the past 5 years, Maltese FIs, Maltese financial institutions, and to a certain extent even banks, have suffered a phenomenon of obstructionism and difficulty in opening bank accounts for correspondent banking relationships abroad. So we were already being scrutinized as a high-risk jurisdiction, and of course being in the list of the FATF has made this a little bit worse. However, being a country under increased monitoring by the FATF might imply that the scrutiny, which we call enhanced due diligence, will become a little bit more stringent, but nothing that we haven't been used to in the past 5 years. So it was a gradual approach, it was a gradual change that we've observed in the industry. The question is, has this stopped financial institutions and the numbers of financial institutions, or the number of financial institutions investors that come to Malta to open, to get a license or get passported? The answer is no. We haven't observed that. There hasn't been a change in that. And so far, although one shouldn't be counting the chickens before they hatch, we do not see a drastic change. The change will be visible within a year or two if we are still in the enhanced monitoring list.
So when you say no change, no repercussions?
There are no repercussions for the time being, and there are no catastrophic events happening. It is more a matter of understanding for the general public especially, what does it mean to be on an FATF, on the FATF grey list, or as we call it, enhanced monitoring list. Because we are now under a larger lens, the recommendation for the players in the industries is to make sure that they take this occasion as a wake-up call. More than a wake-up call, as a way of refreshing their programs, their ML programs, their investments, their systems,
their working methods,
etc. And I know for a fact that this is already being done by the players in the industry. I mean, from discussions held with many financial institutions in Malta, it is very clear that they are understanding what is wrong or what could be done better, and they are changing it. So it is a change that happens at a micro level within the financial institutions, as well as a macro level when it comes to government efforts in changing the way things are actually implemented
in the sector
at a larger scale.
So in your view, like, the way forward should be what?
The way forward, we are to expect positive results. I believe there is always a silver lining in every cloud. I believe that if we are smart, and we are, we should take this as a test or as an occasion, as an opportunity to change for the best. And I would like also to point out that not all grey listed countries are there for the same reasons.
Yes.
So some are being punished for things which are minor, some are being the word punished is some are being monitored for issues which are very, very severe, and the time of presence, of permanence on that list is the meter of the severities of these deficiencies. So I look at this as a test of endurance for us, and an opportunity to reassess and rethink our approach collectively, so that we start changing what can be changed, and correcting the route when this needs to be corrected. I also believe that once the recommendations of the FATF will be implemented, Malta will get out forged and stronger than ever before economically, and then it will be unstoppable.
I'm seeing all this positivity, which is very, very good. I mean, that's what this country ultimately needs. But during this, the preparatory period, while we're preparing to reach certain recommendations made for us, do you see that our economic growth will stop for now, or will still continue to grow?
Economic growth is not something that stops because you are planning or rearranging other elements in the economy.
Okay.
As I said before, financial institutions and the business that rotates around financial institutions that support a system, an economic system, cannot really stop, because industries like, technology, telecommunication, or anything that's not regulated but it's innovative, or even gambling, or the services that support gambling, or any other industry that is served by the financial services partners, are not stopping because of FATF.
Yeah.
So the wheel keeps on spinning. Will it spin faster? Probably not, but it will not stop.
Yeah.
And it will definitely not dwarf or cave in.
Fiorentina D'Amore, thank you so much for participating in this podcast. I encourage you all to follow this chat and other chats with Finance Malta on our YouTube channel, as well as on our social media platforms. Thank you so much.
Thank you.
Thank you.